Hello, everybody. It's your boy, Sean McLaughlin, at Options Sean on the old Twitter X. Back in the home office. Last week, we had to do this jam session from the hotel in New York City, where me and the All Star Charts gang were out there with some of our clients doing some intensive market analysis, as well as some fun, right? But yeah, it was definitely work last week. But I'm happy to be home, back in the old battle station. So for those of you here joining me for the first time, this is the All-Star Options Jam session. And what we do here is we review the portfolio or the trades that we have in All-Star Options. We review any exits that we've had over the past week. We review some high-level market stuff, some things I'm observing. I actually have a lesson to talk about today, or I don't know if it's a lesson or if it's a gripe. We'll see. We'll see where it goes. And then we'll also update some stops and some existing positions that are going our way, as well as a review. We'll touch upon some new positions we've put on in the past week. So before I get into all that, of course, I have to drop the disclaimer that everything we discuss here is for educational purposes only. I'm showing you what I'm doing with my money, and I hope that you learn something from seeing how I go through my process. All right, so let's bring up a chart of the S&P 500. Look, I know a lot of you watching this are, paying attention to the news, getting freaked out about this, that, and the other thing. The Trump, the wars, the tariffs, the deep seeks, the whatever, right? There's lots of things out there that are scary and have people worried. But if you were like me and didn't pay attention to any of this nonsense and just looked at the S&P 500 chart, you would see that we are what? An afternoon away from all-time highs. We are right there below all-time highs. Only price pays, folks. And the noisier the world around us gets, the more important it is to focus on price. If you want to have any chance of making money in the markets, you need to dial in your focus on price, because the price is the only truth out there. We can debate about what is true and what isn't when we're reading headlines and reading news and seeing CEOs on TV doing all kinds of crazy things, right? We can debate what's real and what isn't, but we cannot debate price. Price is the only arbiter of truth that we can trust. All right. So there, off my soapbox, S&P 500 back near all-time highs. Do I have VIX? Yeah, here's VIX, getting back down near the lower levels that we've been for at least for the year. So as far as I'm concerned, there isn't really a whole lot out there from a market point of view to be scared about. Doesn't mean it's going to be easy. Doesn't mean we just go buy everything and it's a bull market. Yay! It doesn't mean that, but it just means that, let's stick to our process. I think we're going to be just fine. All right. So let's talk about some positions that we've exited or adjusted in the last week. We only have two to talk about. Let's talk about FCX. I'm a little salty about this one. This was an Iron Condor. An Iron Condor is a delta neutral trade. We were betting on sideways action. We sold an Iron Condor for 70 cents back here in the middle of January. And the bet that I made putting this trade on is that FCX would stay within this range of 45 on the upside, check, and 35 on the downside. But look at this beautiful little kiss just below 35 earlier this week, which got me stopped out. Now, I know some of you who've been with me for a while know that I focus on closing prices, right? For me, the closing price is the most important price that a stock prints on a daily basis, right? And so I generally wait for the closing price. And then if that closing price is, below or above my stop loss level, then I'll exit the trade on the next day. Now, where that changes is that when we're in a position that is approaching expiration. In this case, these were February options. We are in February. We are 8 days away now from February expiration. And when I'm in expiration month in a position, then I need to be a little bit more stricter and a little bit more nimble and fast acting on my stop losses. Okay. So when a stop loss level is broken intraday on a position that is approaching expiration, that is when I am likely to take action. And unfortunately for me, that tripped me up in this FCX position, because when we traded below 35 intraday on February 3rd, which was Monday of this week, as soon as my little bell went off on my screen, and I was here at my computer, and when that bell went off, I said, oh, time to get out. I closed the position. And you know what? I probably marked the low of the move. It happens. It'll happen again. I promise. But I sold this iron condor for 70 cents. I got back. I closed it for $1.03. So not a terrible loss, but in the context of where FCX is now, we'd probably be hitting our profit target now, if not soon. And so that stings a little bit, but hey, not that big of a loss. We'll take it. Risk management is job number one, and you got to stick to the plan. And I stuck to the plan. I don't regret sticking to the plan. Okay. All right. Next up, AEM. This is a position we are still in. We've just made a position adjustment on. This is a call diagonal spread. We are bullish on AEM. We are long the January 120 calls, but we are selling calls in nearer expirations to help reduce the risk in this position. All right, so we initiated this position for $1.40 back on January 22nd, and we had sold the March 95 calls against those January 120 calls. Well, the stock is moving faster than I thought it would. And the reason I put it called diagonal spread is because I didn't think the stock would move that fast. But right now it's moving faster than I anticipated. So it's not an ideal situation, but we're still in the game here. But once we broke above 97.50, which is the level I had laid out in the blog post when we published this trade, I wanted to roll the calls up to the next available strike, which in this case is the 100 strike. So we rolled those March 95 calls up to the June 100 calls. Unfortunately, we only got a 5-cent net credit, but I went to June instead of rolling to May. I could have rolled to May, but if I rolled to the May 100 options, it would have cost me a debit. I think at the time I was looking at maybe paying a 35 or 40-cent debit. I don't like to do that. And there's nothing wrong with that, guys. If that's what you did, it just means you're adding a little bit extra risk to the trade. You're adding that debit, but nothing wrong with that. But for me, I like to just keep it clean. I like to always collect credits on these defensive rolls. So I rolled to June, and I'm hoping I'll get an opportunity to roll these June calls again for more credits to lower my net cost. So right now, my net debit in the campaign is the 140 I initially paid minus the 5 cents we collected yesterday. So 135. If AEM rolls over and goes to zero, the most I'm going to lose here is 135. Hopefully, we'll get opportunities for more credits down the road. But you can see here, I got 102.50 highlighted up here. If we get to 102.50, I will roll these June 100 calls up, perhaps to the June 105s, to the July 105s, or maybe August. We'll see. We'll see when we get there. But either way, I want to do it for credit. All right, so that's the only action in the portfolio since we last spoke last Thursday. Let's update some stops. We have a few stops to update. So we'll stay right here at AEM. We did raise the stop here, so this stop is now $80, which is far away. You might be looking at that saying, why is that stop so far away? Well, part of the reason is because this is a diagonal spread, and as AEM falls down, we'll have an opportunity, probably before it gets to 80, to maybe roll those June calls out for more credit. So we don't need to be so tight with the risk management in this trade, because we have ways of reducing risk in other ways. All right, but we are raising the stop. If we get below 80, then I don't want anything to do with this trade anymore. I'll close the entire trade down for whatever I can get for it. All right, so next up, NET, Cloudflare. We're long a September 120, 160 bull call spread. This trade is working out really well for us now. We have time. There's a lot of time to expiration, so we're not at near our profit target yet, but we will close this spread. Let's see, it's the most the spread can be worth is $40, so I'll look to sell it for 32, which is 80% of the maximum potential value of the spread. I've got a good till cancel order out there working right now to sell it at 32. I don't think we're close yet. But if we do get to 160, I mean, this thing is ripping, right? If this thing keeps ripping like this, and if we do break 160 sometime in the next month or so, I'll take my profit at that point. It probably won't be 80% of the full value of the spread, but I'll take my profit and just be happy that I got a quick gain on this one. But for now, I'm raising the stop to 116. That 116 level corresponds with the low of these two big wide candles, range expansion days here. Marks the low of that. Plus, it also corresponds pretty closely with the rising 50-period moving average, which is something I like to pay attention to, as you've heard me say many times before. And finally, Robinhood. This is another trade similar to Net. It's a bull call spread in June options. It's going our way. Same thing. I got a resting order to sell this spread at 80% of the full value. So in that case, this would be $16. The full value of the spread is the most it could be worth is 20. I'll be happy to sell it at 16 if I get a chance to. But I'm raising my stop now to 43. 43 roughly corresponds with the upper resistance that we are experiencing here towards the end of the year, of the past year. And of course, it also corresponds with the rising 50-period moving average. If we get below 43, that to me tells me that the trend has exhausted itself and I will want to be out of Robinhood. Okay, I told you I had a lesson. And I maybe should have started with this earlier, but I want to bring up something, guys, a trade in Hershey. Some of you may remember, if you've been with me for a while, or have been with us at least for the past year, we got long puts back here in October. When Hershey broke this level, this was a support that was at least 52 weeks in the making. When we broke that support, this was a very, very bearish signal to me, and I wanted to get short, and I did. I bought the February 175 puts for 550 right here on this day. You could see here, we had a big face ripper in our face that stopped us out, right? Right here, my stop level was 185 at the time. On December 6th, we had a huge ripper. We closed above it, well above the level. And on the next day, following my process, I closed the trade out. I didn't lose all that much, thankfully, because when this move happened, there was some buyout rumors or maybe buyout news. I don't remember what the news was, but something about a takeover, right? And it just ripped the stock. So there was still a lot of premium left in those options because of this news uncertainty. So that helped cushion the blow on the loss. But man, as you could see, as soon as I got out, the thing just resumed lower, getting killed, right? Now, the last 2 days have been very challenging, but if I were still in this trade right now, if I had not gotten stopped out, I'd be sitting on a 4x profit on this trade, at least right now, and more a couple days ago. But the lesson I want to there's two lessons here that I wanted to talk about. Number one, I want to talk about the importance of sticking to our plan, right? Let's move the chart over a little bit and take away what we already know. Let's get rid of the hindsight bias, right? When this chart's right here and this thing rips up higher, I have no idea that the trend is over. Or, I mean, I'm sorry, as far as I can tell, the bearish trend is over. This is a very clear signal that we have reversed, right? Or at least the change of character. There's been a very clear change of character. And yes, my risks are defined. The most I could lose is the 550 debit I paid to get in. But I don't want to lose 550, not if a chart pattern is clearly violated. And when I look at that chart pattern, I'm like, oh, well, I mean, maybe scooch this over even a little bit more. Let's get a little skinny over here. I'll zoom in for you a little bit, Gene. To me, that's a clear indication that the trend is over. I can't predict the future, but that's what that tells me. So do I regret getting out? No, I stuck to my plan. Okay. That's lesson number one. Sticking to our plan doesn't always work, right? We'll have regrets in hindsight, but I promise you that if you stick to your plan long enough, for every one of these trades that you regret that you didn't hold on to, there's 50 others that you're glad you did. Okay. And net, you're going to be a winner over the long run by sticking to your plan. Now, this sucks, right? This feels like a huge missed opportunity, and I'm salty about it for sure. But I can't feel bad about sticking to your plan. Now, the other thing I want to point out too, and I'll be writing about this later, I'll be putting it out in an email, but Traders love to talk about bear markets. They love talking about getting short. We all know the sexy stories of people like Michael Burry and people like that who just made huge short bets and made huge killings, huge profits, right? George Soros breaking the Bank of England. Like these stories, they're sexy, right? People making money on the short side because when you make money on the short side, often those profits happen fast. Bearish bets happen fast because you've probably heard the expression, stocks take the elevator up or the escalator up and the elevator down, right? It happens over and over again. So it's very appealing to make money on the short side. The problem with making money on the short side is that if you have anything longer than a day trade mindset, making money on the short side is incredibly hard because, and Hershey's a perfect example. When you're short and the trend is down, you have so many face rippers. We had one here in November, right? A little 5-day face ripper. Then we had the thing that stopped me out. That was a big ripper. And then look what's happened in the last 2 days. I mean, on Tuesday, February 4th, when we have this big red candle, if you're holding a bearish position here, you're feeling great. Look at this thing. This thing's following through. It's crashing to the downside. I am going to rake it in. And then look what happened the last 2 days. I mean, so many bears got stopped out. And maybe they'll regret it just like I did 2 months ago. Who knows? But bearish positions are incredibly hard to manage risk in because bear market rallies are so tricky and they're sudden and they happen fast. And the entire world's conspiring against you when you're short. Think about it. When stocks are going up, everybody's happy, right? Shareholders are making money. Customers are happy with the product. The employees are happy because they're getting rich because they have stock in the company. Everybody's happy. Everything's great when the stocks are going up. There's nothing that you need to do but just get out of the way and keep doing what you're doing because everything's working. But when a stock's going down and making new 52-week lows or making all-time lows or whatever, when a stock is tanking, bad things happen, right? Shareholders get upset. Big shareholders and institutions start looking for somebody to blame and maybe start firing off lawsuits against the company or their executives, right? Customers start fleeing because they think, oh, this company is no good. I'm going to go look for an alternative. Employees, your star employees are going to start looking for other opportunities because they're not making any money anymore. Their stock is worthless because the stock's going down. They're worried about their personal net worth. So they're going to start looking for other opportunities. And then the funding cost for a company gets more expensive, right? Like it costs more money to cost more higher interest rates to borrow money. And the equity market's no place to raise capital because your stock is getting decimated. So nothing but bad things happen when stocks are going down. And so companies have every incentive to use every tool in their toolbook in their toolbox to do whatever they can to juice the stock price higher. They're going to issue press releases. They're going to talk about new customers. They're going to issue stock buybacks. They're going to fire the CFO and hire a new CEO. They're going to do whatever they can to stop the stock from going down. So if you're holding a short position on anything longer than a day trade, these forces are conspiring against you, or the stock could get taken over, right? Once the stock is cheap enough, a competitor might come in and buy them at a higher price than what you're short, right? So everything is conspiring against the short seller. It doesn't mean you can't make money on the short side. I've made money on the short side. I know lots of people that make money on the short side, but it's a very different game. It's not the opposite of making money on the long side, okay? It takes a different skill set. You have to be faster. You have to have very strict risk management. And man, it's not easy. And this Hershey trade is just one of those examples. So I wanted to talk about that. Sorry about going off on a tangent, but I was reviewing some of my trades from earlier in the year, and this chart popped up on my screen yesterday, and I was like, oh, I like once I got out of the trade, I just kind of forgot about it, and I didn't know that Hershey had continued falling, and I popped it up yesterday. I was like, oh my, look at all these profits I left on the table. But hey, that's trading, folks. That's trading. All right, the last thing we'll touch upon real quick is the new trades we've put on in the last week. And as I say every week, I'm not going to have the trade details up here. If you want the trade details, you can go to allstarcharts.com, head to the members section, head to the options section, and you will find detailed trade plans of every trade that I put on. That trade plan includes the setup and why I like it, the option strategy that I'm using to employ to express my thesis, where I'm managing risk, where I may stop out, where I may or may not take profits, how I may adjust position going forward. All of those details are laid out in every blog post for every trade that we put on. So if you don't have access to that, please reach out to us, get involved. All Star Options. We'd love to have you as part of the community, which we are a community. We have a live chat room. Many of our customers are in there, engaging with me, engaging with each other, sharing ideas. It's getting better every week, every month. So would love to have you a part of it. So with that disclaimer out of the way, I'll just tell you real quickly. We put a bullish trade on in Visa early this week. We put a bullish trade on in it's now called PDD Holdings. It used to be called Pinduoduo, I think is what they called it. It's a Chinese stock. This is a play on China, on the relentless bid in China. We think that China stocks, not just PDD, but many others, are setting up really well here. So this is a play on that. This is a high beta name. So we're bullish PDD, and I'm bearish on Semiconductor Corp. I got into a bearish trade yesterday. Market's not agreeing with me yet, but we got time. This is a shorter term trade for me, by the way. It's a very earnings specific. We have earnings coming up, and that's the catalyst I'm leaning against to make profits in this trade. But again, all those details can be found at allstarcharts.com. All right. Let me just bring this up real quick. You guys, I think my screen is hanging. There we go. There's my updated stops. We reviewed these, but just for those of you who want to take a screenshot, there they are. Those are the stops we updated this week. And lastly, any questions at all? If you want to get involved in All Star Options, or if you have some follow-up questions on any of the trades that I discussed here, shoot us an email, info@allstarcharts.com. It'll get routed to me and I'll be able to answer you directly. Also, if you want to get involved in All Star Options, if you're not there yet, there's the link, stockmarkettv.com/get All Star Options. Finally, if you'd like the charts I share, my friends at TrendSpider have hooked us up. You get a 50% discount on a subscription plan to trendspider.com. Just use my promo code Sean50, and my friends over there will hook you up. All right, guys, that's all I got for you. I hope you have a great rest of your week and a great weekend. Enjoy the Super Bowl. I'm a little salty about the Super Bowl. My Bills didn't make it. As a Bills fan, I'm just used to that. But enjoy the Super Bowl for those who partake, and we'll be back at it next week. Take care, everybody.